I was once told that public speaking is probably the biggest fear that people face, even more so than passing away, which seems kind of crazy, right? Like if you were giving the eulogy, you'd be more fearful than actually being in the box. Today, what we're going to talk about is another fear that many, many people face, and that's the fear of what happens if you run out of money in retirement. Today, it's March of 2022 when this is being filmed, and now more than ever, stock markets are going crazy. There's a lot of volatility. And if you're what in some people call the retirement red zone, right? The first 5 years before retirement or the second 5 years after retirement, that 10-year period is really crucial to you being able to sustain your money and sustain the income that's created from your portfolios in retirement. And now, because of all the volatility, people are getting shook up. They're getting scared and they're wondering, oh my God, what happens? May I or will I run out of money when it comes to my retirement portfolio? This is something we haven't seen in quite a long time because for the longest time, markets have been doing very well and people have been, slowly saving their money into those markets. But now, if you're close to retirement, it's time to really watch what's going on with your portfolios. So let's start with what happens if you run out of money, right? Let's say you spent through your entire 401k or IRA or wherever you have been saving your money, right? Now what? Well, now you're left with Social Security, right? Which hopefully you've put in enough time to take your Social Security. Well, you have that piece, and thank God that that's there. But what else do you do? Well, if you have a home, you do have the ability to do a reverse mortgage, but does that make the most sense for you, right? Do you really want to hand over control of your house to the bank just in order to get money or a monthly income from it? So those are things that you have to consider. But if that's your only option, it may be the one thing that you can do. Obviously, there's other scenarios that can happen. Of course, you could go move in with your kids or in-laws or friends or family or whatever that might be, but is that really what you want to do? So let's talk about some of the things that people have been doing for a long time when it comes to retirement distribution. And we're going to talk about something called the 4% rule. This is something that you might have heard about, but there was a study done or a paper written about the 4% rule, and the author, Bill Bangan, when he did this study, he looked back through time and looked at all these different 30-year periods to see how much money somebody could withdraw from their portfolio to sustain that portfolio for 30 years. So what was the highest amount of money they could take out each year? And the number that he ended up with was 4%. So to put it in context, if you saved $1 million into your retirement account and then you pulled 4% a year from that retirement account, that's $40,000 a year. And that $40,000 is all that you could take to sustain that portfolio for that given period of time. And since that period of time, there's been a lot more studies that have gone on. And in those studies, they've actually found that from the middle 90s to today, there's been far more volatility. And because of that volatility coupled with low interest rates, that number has gone down, and it's gone down in multitudes from 4% down to about 2.8%, which is really scary to think that you have $1 million, and in order to make that last 30 years or more, that's $28,000 a year. The answer to this strategy for most financial planners is one of two things, right? They're either going to tell you to delay your retirement and keep your income coming in so that you have less risk of running out of money, right? Because maybe you don't need to have that portfolio for 30 years. Maybe you only need it for 25 because you worked an additional 5 years, right? But is that really what you're looking to do? And then the next best answer that they have is if you don't want to work more, you could spend less. And really, if you've worked your entire life and you want to enjoy your retirement, is the answer to a happy and fun retirement spending less money? Do you really want to have less money in retirement than right before you retired? There's a number of different strategies that some of our clients have looked at. And, these are things that you can start to investigate for yourself. But, an annuity for part of your money may be a good strategy. And let me talk to you about why people use annuities. The number one goal or the number one purpose for that annuity is to create guaranteed income in the future, right? So to have guaranteed income, it's almost like having another Social Security check that's coming in, right? You have your Social Security that comes in every month, and hopefully that continues for forever. If you have an annuity, what happens is you take some of your money, you put it in there, you lock it away from volatility, and in return, the insurance company gives you a guaranteed paycheck every single month for as long as you live. Another strategy that people employ is something that we call the volatility buffer. And the idea behind the volatility buffer is, when markets are fluctuating, do you really want to take money from your invested assets? Because what happens when the market drops? If you take money out of the market while it's dropping, you've essentially locked in those losses, right? And your portfolio, it becomes harder to sustain because as you're pulling money out and it's losing value and you lock in those losses, when it rebounds, there's not as much in there to continue to go back up. So for the longest time, what you've been doing is you've been putting money into the market consistently. And by doing that, you've created dollar cost averaging, and you've bought on highs and you've bought on lows, and you earned an average rate of return. But in retirement, what so many people fail to realize is the average rate of return doesn't matter. And what really matters is the sequencing or those returns you get year over year and what that looks like when you're drawing money out. So by having this volatility buffer, what you're essentially doing is creating another bucket of money that's not correlated to the stock market, that's free from the whims of what's happening in the market, so that when markets drop, you're able to pull money out from that and use that money for your income so that your retirement invested assets can get the time to recover, right? Because markets go down, but they also go back up. And if you allow or you have time for those assets to recover, that will sustain or lengthen the amount of time that your portfolio can provide for you. I just gave you two different strategies. One using an annuity to create a guaranteed income in retirement, right? That's free from the whims of the market. The other, creating a second bucket of money as you're setting up for retirement, called the volatility buffer. And all of this really depends on where you're at in your journey, what's most appropriate for you. So if you're looking for help in, hey, I'm a couple years from retirement, or I'm in retirement and I'm really scared, what do I do? Wherever you are on that journey, click in the link below. One of the team members will reach out to you and we'll be able to walk you through and help you build out a game plan specific to you, specific to what you're looking to create, what you want retirement to look like, or if you're already in retirement and enjoying those years, how do you do that with less stress because you don't need to be fearful of the market? And if you're enjoying this content, go ahead and give it a like. We put out new content every single day. We're growing the channel. We would love for you to subscribe and keep on with this education.